Welcome to Hit the Brakes, where we dive into the top stories, market trends, and ins and outs of the supply chain. No matter if you're tuning in from the cab of your truck, behind your desk, or on your daily commute, we're glad you're here and we're ready to serve you. Let's get this show on the road. This episode is part one of our three-part series from the Freight Forecast, Truckload Rate and Market Trends webinar with ACT Research. This episode is all about demand conditions in the 2024 freight market. Make sure to join us next time when we look at supply conditions, and again for part three, when we will bring all this together and talk about what the data means for you. On behalf of Fetch Freight and ACT Research, let me say welcome. We hope our time today will be beneficial as we kick off what will surely be another interesting year in transportation. And at the end of the day, we're here to review the January 2024 ACT report freight forecast. And I wanted to say, interestingly enough, we've been working on this for roughly 6 months. And I thought it was interesting that we did not finalize today's agenda until Monday. And I think that really speaks to how fluid things are in this industry, how quickly things can change, and how we all have to be on our toes and looking around the corner, so to speak. So with that being said, let's get started. So Tim, thank you so much for joining us today. We appreciate all that ACT Research does for us here at Fetch and the industry as a whole, and educating us and helping us prepare for changes in markets and just knowing how to plan for what's ahead. So with that being said, welcome, Tim, and let's dig in. So container rates are way up over the last few weeks. And can you tell us a little bit about why that is and what impacts this could have on the year ahead?
Absolutely. First off, thanks, Mitchell, for having me, and we appreciate the work that you do, and we appreciate the partnership as well. As we start to look at the outlook for 2024, I think it's really fascinating right now, and really probably the source is just this 94% spike in global ocean container spot rates in the first 2 weeks of the year. It's a nice way to kick it off.
Yeah.
I mean, not nice if you're a shipper.
Yeah,
but,
right.
Interesting way to kick it off. Certainly there's a lot of disruptions across the oceans. It's not just what's happening that we're hearing about pretty much every day in the news right now in the Red Sea. But the Panama Canal issue has been brewing for quite some time. And I think the confluence of those two things, neither of which seems like it's going to end soon, are starting to really press freight in a lot of different directions around the globe. The capacity impact from rerouting ships from the Suez around the Cape of Good Hope, which is largely what's happening right now, is really significant on the ocean. And I think demand is recovering in general. I think we're seeing some good signs regarding U.S. goods consumption trends, and we can get into that more. But I think the biggest factor in this jump is that supply pinch on the ocean. So 100% of that's not going to transfer over into surface freight, but there's going to be some really interesting reverberations and implications through the year.
Okay.
Yeah, Tim, I just want to read out a couple stats, but you mentioned the Cape of Good Hope, and I think for the casual observer and for many of the attendees, you kind of alluded to it in the news cycle. You're hearing about the Houthi rebels, the impacts on container shipping through the Red Sea. Recent print is 80% of the container freight through the Red Sea is rerouted along the Cape, including Maersk, who's ceased operations through the Red Sea. I think that's pretty interesting. But overall, these two issues you highlighted, the Suez Canal and volumes, decreasing through there, as well as, the water level issues, challenging throughput with the Panama Canal. Overall, the impact is that East Coast port imports will be a challenge, logistically. Lead times going around the Cape, increase significantly, has impacts on restocking, impacts on inventory. But is the big winner the West Coast in this situation?
I think yes. I think that's the very clear answer is that we've had this big shift over the past couple of years to all water shipping to the East Coast, really taking advantage of that deeper Panama Canal, and that's just not available right now. And so that is quickly shifting back to the West Coast. And so, from a global just mode perspective, ocean's going to lose share to land this year.
That's interesting. I think when you think about the West Coast as, potentially this big winner of this volume for imports, thinking back to the pandemic, there's probably a lot of trauma and scar tissues for those who were involved with that type of operation. You think about the videos and the images of container ships anchored off of port. You had, union labor constraints also at the ports. What's different this time around? If I'm a shipper and importer, I'm, maybe hearing this probably brings up some bad memories, but are conditions different today than they were in the pandemic that might be able to facilitate that volume?
Well, that's a good question. Actually, the labor point is a really interesting, different this time because a couple of years ago it was the West Coast labor negotiations, and coming up this year we have East Coast labor negotiations, and so that only serves to reinforce that trend pushing towards the West for now. I do think that a lot of capacity has been put in place on the intermodal network, and I think that continues to be a big question, frankly, of how the network can scale up this year. We're experiencing some cold weather right now, and we can talk more about that. But the intermodal volumes are under a little bit of pressure just this week, and we're seeing some of that start to spark some activity in the truckload spot market this week.
That's interesting. You mentioned intermodal. I was actually kind of curious, with these imports coming in and, potentially landing, maybe unexpectedly, higher in the West Coast this coming year, kind of as a result of, some of these ocean challenges. Is intermodal the big winner when it comes to U.S. surface freight?
I think overall, yes. That's an easy question to say yes to from a proportionality perspective, because it's not a huge piece of the overall freight network. It's going to have the biggest impact, but it'll be really interesting to see if the intermodal network sort of can grow more than mid-single digits this year. We recently raised our forecast just a little bit from 5% growth to 6% growth, thinking that. Goodness, there's so much demand, but what's holding our forecast back is frankly just not having the conviction that the capacity is going to be able to respond.
That's interesting, and I think we've got up here even on the slide, just projections of inventories and restocking continues to be such a prominent headline of have we worked down our inventory levels low enough, the resilience of the consumer. This, when you're forecasting shipment volume, and you can even see down on the bottom right, your shipment forecast through the cash report, you're projecting 5% year-over-year growth by the end of the calendar year. Something you just kind of alluded to is that, this could be a year of growth on the shipment front. Is this restocking narrative, particularly when you think about ocean freight and container challenges, is this the narrative? Is that a key part of what is going into the forecast on volumes?
Yeah, absolutely. Inventories are a big piece of the equation this year, and a huge shift from the 18-month destock that we've just been through. I think that's one of the biggest stories of 2024 is shifting back into restock mode. And the retail restock is certainly still debatable. There's certainly some places in retail that probably could still stand to destock further, but we've already done so much destocking that just going back to a more static inventory environment would actually add to freight relative to last year, and that's where you get some of those easy comps sort of later this year, and you get those mid-single digit growth rates. But coming back to what's happening on the ocean, you talked about the scar tissue earlier a few years ago. I think a lot of shippers are under stress right now in terms of keeping supply chains moving, and all that stuff that was is being delayed around the Cape of Good Hope. You're hearing about plants having to take some downtime here and there, which is extremely expensive. So in the short term, that's certainly supports air freight, which is one of the only ways to avoid those types of downtime. And I think that's probably happening in many places just to keep things moving. But we are, from a freight volume perspective overall, we're pretty well below trend. If you look at the Cass freight index, the shipments component as a good benchmark, and the forecast, to get back to a pretty decent growth environment, keeps us even below trend, I think, through most of this year. And I'm not expecting us to get back above trend until sort of well into 25.
I think, one thing, I think even we spoke about this a couple of days ago when we were kind of talking through the report, but, the container challenges, the spike in price, inventory restock, a lot of times when you think about inventory restock, it's in preparation for demand. You just kind of talked about production lead times and, ultimately, rerouting along the Cape of Good Hope, all that inventory that's in transit is seeing longer lead times, if they reroute. I'm just kind of curious, is this kind of leading into more of a potentially a supply driven restock versus a demand driven restock, trying to get out in front of the capacity rates? Do you think that this could kind of generate maybe a shuffle to try and secure this capacity and ensure that they do have their raw materials and their inbound goods from, Asia and some of those markets? Do you think that could be leading some of this inventory push?
Yeah, absolutely. I think that's what those spikes in rates will tell you, is that shippers are out there basically saying, hey, we have to build safety stocks at this point. Now, to some extent, that'll offset some of the need to rebuild inventories later this year, from just that consumer-driven trend, which is still very early on. We did get a really nice retail sales number for December just yesterday. Those can be pretty volatile. That's the first reads, but it looks good. And eventually, I do think that retailers will need to restock. Just because the U.S. consumer has reached that point, and we have gone through, as you can see on that chart on the top right there, we have gone through the longest and deepest destock on record outside of recessions. So we're already, we've arguably it's tough to find the right inventory to sales ratio, I suppose, for the overall economy, but I think there's a real strong case that shippers, well, I'm not suggesting that there's a mad dash for capacity just yet. I mean, capacity generally in the industry is going from loose to kind of balanced, and is in that early stage. But as this year progresses, I think things will progressively tighten.
I just want to read out a couple statistics. This is from deep in the report. I wanted to just get in the macro just very briefly, but ACT Research, your report is kind of predicated on a 2% base case for GDP in 24. The wisdom of the crowds is betting on interest rate cuts coming this year. It looks like your team's forecasted 325 basis point cuts to come through in this year. I think just for the casual observer again, and for the attendees, when you think about this narrative of rate cuts coming, outside of the consumer, more about the freight market, will these rate cuts be enough to serve as a tailwind, or will this kind of keep us close to par for the economic forecast as current? Is this more soft landing relative to current state, or could this potentially be a tailwind for growth, if these cuts do come to fruition?
Yeah, I think that's a great question, and I think that kind of pushes us forward to the 25 forecast a little bit. I think one of the Fed presidents, Bostic, said just yesterday, or maybe even today, that he wasn't expecting rate cuts to begin until the second half, which seems like a reasonable expectation right now. And to the extent that they start cutting in the second half, that's, I think, going to provide some fuel for growth in 2025. I don't think it's going to impact 24 too much, one way or another. I think the sort of optimism in general, and I guess relief, if you will, that inflation has come down so much. I think that certainly, is a good sign for growth in the near term. But my gut right now at the moment would suggest that that expectation for 3 cuts next year is a little bit of a risky expectation. And the financial markets are smarter than me, I guess. But what I would suggest is, as we're looking at this spike in global container freight rates and the likelihood that overall freight rates are going to start rising this year, that's one of the disinflationary factors that has helped the overall macro conditions to ease. Certainly energy prices are a piece of that, and oil prices are still pretty low. So in general, I think disinflation, that trend should continue, but there are risks that the labor market is still very tight. Initial claims this morning were ridiculously low. We're still have a very strong U.S. job market, and that's going to continue to put some upward pressure on inflation too. So all those things suggest that maybe we won't get 3 rate cuts next year. I don't know.
Yeah.
Excuse me.
Yeah, I thought that was interesting. I think the BLS actually came out with some data today showing, jobless claims were much lower than what was expected. So I think this continues to be kind of a wait and see. A lot of these factors that maybe were forecasted months ago have not yet come to fruition. The odds of recession, even in last year, tail end of 2023, didn't happen. Consumer resiliency continue. It looks like for this year, the economics team at ACT is projecting about a 15% chance of recession, basically sticking to the soft landing narrative. If the interest rate pivot does not come to fruition in 2024, what should we expect from a freight market volume standpoint? I would expect that would be a headwind to current forecasts. Would that be accurate?
Well, other things equal, yes, but I think that would be in the context of a really strong economy. So I think probably no major impact. I think that would be supportive of the forecast overall. And so I think, while the narrative overall from a big picture perspective does not suggest that we're going into any sort of severe recession at this point. There's certainly still some risks from higher interest rates that are out there, and savings rates are kind of low, and there's some concerns for sure. But that soft landing narrative, seems like the most likely outcome at this point. But all that said, if you look at the Cass Freight Index again, we've been through about an 18-month downturn in the freight markets. So while there was no, I guess the overall economy is going to hit a soft landing, but there have been some rolling recessions, including in our sector.
Thanks for joining us on Hit the Brakes podcast. Want to know more about today's episode? Visit fetchfreight.com to connect with someone from our team, get a quote, join our carrier network, and more. Check out the show notes below for specific links mentioned in the episode.